Gold just broke a level analysts said would hold. Silver is dangling above a number that, if it breaks, could open the door to a much deeper fall. And one veteran market strategist is now saying something most investors don't want to hear. The bottom is not in yet. Somewhere between $4,000 and $3,500 lies a line in the sand. Cross it. And the next few months could look very different for anyone holding precious metals. So the question isn't whether volatility is coming, it's whether you'll be positioned before it arrives or after. Welcome back to Precious Metals Intelligence, the channel built for investors who prefer clarity over noise and preparation over panic. If you're new here, this channel exists for one reason, to break down what's actually happening in the gold and silver markets, without the hype and without the fear-mongering that dominates so much of this space. Across the world, investors are watching two metals that have quietly defined wealth protection for thousands of years. Gold and silver have spent the past several weeks trapped in a tense, narrow range. Prices rise a little, then fall back. They test old highs, then retreat toward old lows. To the casual observer, it might look like nothing more than normal market noise. But to those who study these markets closely, something more important is happening beneath the surface. The tension in these markets did not appear out of nowhere. It follows real pressure building in the world around us. Conflict in the Middle East has pushed oil prices higher. Higher oil tends to raise expectations for inflation, and when inflation expectations rise, interest rates tend to follow. This combination of forces has placed direct pressure on both gold and silver, even though both metals are traditionally seen as safe places to store wealth during uncertain times. This is where the story becomes more interesting. One respected market strategist has been studying the charts closely, and he believes the pattern forming right now deserves serious attention. He is not predicting collapse. He is not predicting doom. What he is pointing to is something far more specific and, in some ways, far more useful for investors trying to plan ahead. On the gold chart, he sees a shape forming that professional traders take very seriously. It is called a wedge. In simple terms, a wedge happens when the price of an asset gets squeezed between two lines. One line runs downward, marking a ceiling that price cannot seem to break through. The other line runs upward, marking a floor that price keeps bouncing off. Over time, these two lines move closer together, like a triangle tightening from both sides. What makes this pattern important is not just its shape. It is what each failed bounce tells us. Every time gold has tried to rise toward that upper ceiling in recent weeks, it has failed to reach it. Each attempt has been weaker than the one before. To a trained eye, this is not a sign of strength returning to the market. It is a sign of strength slowly draining away. The buyers who once pushed prices higher with confidence appear to be losing some of that confidence, even as the floor beneath the price continues to hold for now. That floor is the part investors should pay closest attention to. Right now, gold has found support near a key price zone, a level that is held firm even as pressure builds around it. This level matters because it represents a line in the sand. As long as price stays above it, the broader uptrend that gold has enjoyed for years remains intact. But just below that current support sits another, deeper zone. If gold falls through the first level and continues down toward this second, lower zone, it would open the door to a much steeper decline than most casual investors are currently expecting. This is not a small technical detail. For anyone holding gold as part of a long-term wealth strategy, understanding where these lines sit could be the difference between reacting with panic and reacting with a plan. Markets rarely move in straight lines. They test, they retreat, they test again. What matters is understanding which tests are ordinary noise and which ones signal that something larger is shifting underneath. The strategist's warning is not that gold is broken. It is that gold, like every asset built on decades of history, moves in cycles. And every cycle includes a phase where weakness must be worked through before strength can return. The question he is raising is simple, but history rarely repeats itself in exact detail, but it often rhymes in ways that reward those who pay attention. To understand what may happen next in the gold market, it helps to step back from the daily price swings and look at the bigger picture. Analysts who study long-term cycles believe the past holds real clues about what lies ahead. And one strategist has spent considerable time mapping gold's major turning points across the last several decades. Two moments stand out clearly in that history. The first came after gold reached its peak in 1980. What followed was a long and painful decline, one that eventually saw gold fall by roughly 66% from that high point. It was a brutal stretch for anyone holding the metal at the time, and it took many years for prices to recover fully. The second major peak came in 2011. This time, the decline that followed was smaller. Gold fell by roughly 46% from its high, a steep drop, but noticeably less severe than what happened after 1980. This difference is not just a random coincidence. According to the strategist's research, it points to something structural happening in the global economy. Each time gold has fallen from a major peak, the size of that fall has grown smaller. The 1980 decline was deep. The 2011 decline was shallower. This pattern suggests that each new cycle finds support at a higher floor than the one before it. Why would this happen? The answer lies in forces that have been building steadily for years, forces that do not disappear simply because prices pull back for a few months. Government debt around the world continues to grow year after year, regardless of which party holds power or which country is being discussed. At the same time, central banks have repeatedly turned to policies like quantitative easing, essentially creating new money to support their economies during times of stress. Both of these forces tend to work in gold's favor over the long run, because they slowly erode confidence in paper currency and push investors toward assets that cannot simply be printed into existence. There's another piece to this puzzle that deserves attention. Since 2022, central banks around the world have been buying gold at a record pace and storing it in quantities not seen in decades. This is not the behavior of institutions that believe gold is losing its importance. It is the behavior of institutions quietly preparing for a future where trust in traditional currency systems may continue to weaken. Taking all of this together, the strategist believes the current cycle may follow the same pattern of shrinking declines. If the math holds, this cycle's drawdown could fall somewhere between 30 and 37% from gold's recent high point. That would place a potential floor for gold somewhere in the mid-$3,000 range, a number that sounds dramatic in isolation, but fits neatly within the historical pattern once the full context is considered. It is important to understand what this means, and just as important to understand what it does not mean. This is not a forecast of endless decline. It is the opposite. Each smaller drawdown across history has eventually given way to a stronger, longer bull run than the one before it. If this pattern continues, then the current period of weakness may simply be the necessary setup phase before the next major upward move begins. This raises a compelling question, one that patient long-term investors should sit with carefully. If each cycle's decline keeps getting smaller and each cycle's eventual peak keeps climbing higher, what might that suggest about the size and speed of the next major bull run? Some analysts believe the answer could be more dramatic than most people currently expect, and the timeline for that next major move may be shorter than history has ever shown before. If gold is the steady, disciplined sibling in the precious metals family, silver has always been the more unpredictable one. It moves faster, swings harder, and tends to exaggerate whatever gold is doing in both directions. This is why so many experienced investors watch silver closely during uncertain periods. And when trouble is brewing, silver often shows the signs before gold does. Right now, the strategist studying these markets sees a pattern on silver's chart that he describes with real caution. It is known as a bear flag, a formation that often appears after a sharp decline, when price briefly rises again before continuing lower. In this case, silver had already broken below a key support level, then attempted to climb back up toward it. That attempt failed. Instead of breaking through and reclaiming that level, price was pushed back down, a sign that sellers remain firmly in control for the moment. There is a specific price zone he is watching closely, a level that has acted as a floor in recent trading. If silver breaks below this zone, it would likely open the door to further declines, potentially testing levels that many investors have not seen in some time. He outlines a few possible stopping points along the way down, each one representing a deeper level of concern should selling pressure continue to build. Some of these levels sit meaningfully below where silver trades today. This kind of movement might sound alarming on its own, but it becomes easier to understand once you consider how silver has always behaved. It is simply a more volatile metal than gold. Its market is smaller, its price swings are larger, and it reacts more sharply to shifts in investor sentiment. What would be considered a dramatic move for gold is often just an ordinary Tuesday for silver. This is precisely why the strategist believes one more significant leg lower remains possible before a true, lasting bottom fully forms. To make sense of where silver might be heading, it helps to look at its relationship with gold, something analysts refer to as the gold to silver ratio. This ratio simply measures how many ounces of silver it takes to equal the value of 1 ounce of gold. History offers some useful reference points here. Back in 1980, that ratio sat around 16 to 1. By 2011, it had widened out to somewhere near 32 or 33 to 1. During the most recent major run higher, the ratio settled closer to 45 or 46 to 1, noticeably wider than either of those earlier periods. Why has the ratio stayed wider this time? Much of it likely traces back to those same central banks mentioned earlier, the ones steadily accumulating gold since 2022. Their buying has supported gold's price in a way that silver, which lacks the same central bank demand, simply has not experienced. This helps explain why analysts feel more confident projecting specific price targets for gold than they do for silver. Gold has a powerful, consistent buyer group behind it. Silver's demand story is different, and in some ways more interesting. Because while silver lacks central bank backing, it has something else working steadily in its favor: real, growing industrial demand. Solar power technology relies heavily on silver. Data centers expanding rapidly around the world require it as well. Electric vehicles use meaningful amounts of silver in their electrical systems. And on the horizon, new solid-state battery technology may create yet another source of long-term demand, even though that particular application is still developing slowly, and manufacturers are already exploring ways to use less silver per unit as the technology matures. This creates an interesting tension. In the short term, silver may still face real downside risk, possibly touching levels well below where it trades today. But underneath that short-term weakness, the long-term demand picture continues to strengthen quietly, steadily, and largely out of the daily headlines. For patient investors willing to look past the next few months, that combination of short-term caution and long-term opportunity may be exactly the kind of setup worth paying close attention to. There is a particular mistake that even experienced investors make during periods like this. When prices fall for a few weeks or a few months, it becomes easy to assume that something has fundamentally broken. The mind naturally searches for a story that explains the pain, and often that story becomes more dramatic than the facts actually support. This is one of the most important lessons in long-term investing. Short-term weakness and long-term trend reversal are not the same thing, even though they can feel identical while you are living through them. The strategist's analysis suggests something different from a broken trend. It suggests a pause, a natural and even necessary phase within a much larger pattern that has repeated itself across decades. For investors who are building wealth over years rather than days, periods like this have historically represented something closer to opportunity than danger. The challenge, of course, is that opportunity rarely feels comfortable while it is happening. It usually feels uncertain, even a little unsettling. This is why separating short-term traders from long-term investors matters so much right now. A trader focused on the next few weeks has real reasons to be cautious, watching support levels closely and reacting quickly to any break lower. But someone focused on preserving and growing wealth across the next decade is looking at an entirely different picture. For that second group, periods of weakness within a long-term structural uptrend have often marked some of the more favorable entry points in market history, not because the risk disappears, but because the reward for patience tends to grow. The macro backdrop reinforces this view. Inflation pressure has not disappeared from the global economy, even when headlines quiet down for a while. Government debt continues climbing in country after country, with no serious sign of reversing, and central bank policy, no matter how confidently officials speak about future targets, continues to face real limits. When a new Federal Reserve chair states an intention to bring inflation back down to 2%, that statement reflects a goal, not a guarantee. Achieving it would likely require a level of monetary discipline that has proven difficult to sustain in the past. These are exactly the conditions that have historically supported gold and silver over long stretches of time. Neither metal can be created out of thin air the way currency can. Neither depends on a government's promise to hold its value. This is precisely why central banks themselves have been accumulating gold at record levels since 2022, positioning quietly for a future they may see more clearly than the general public does. Looking further out, the strategist has offered a longer-term projection that sounds almost unbelievable at first glance. Based on the pattern of shrinking drawdowns and expanding bull cycles across gold's history, he suggests the next major peak could eventually reach somewhere in the range of $13,000 an ounce. This is not a near-term prediction, and he is careful to frame it that way. It is a multi-year outlook, built on patterns that took decades to form, not a target anyone should expect within the next few months. Numbers this large can feel disconnected from reality, especially when today's headlines are focused on whether gold will hold 3,500 or drop toward 4,000. But every long-term trend begins somewhere, often during a period that felt uncertain and difficult in the moment. The investors who eventually benefited most from previous gold cycles were rarely the ones who tried to perfectly time the bottom. They were the ones who understood the larger pattern and positioned themselves accordingly, even while short-term uncertainty remained unresolved. This brings every serious investor to the same practical question, one that no amount of historical data can fully answer. It is not really a question of whether the long-term case for gold and silver holds up. The deeper question is far more personal and far more urgent, given everything discussed so far.